Hello, I'm going to try to show you how to do a roll on it. This is one of the 2040-60 calendars that's already been rolled a few times, and you can see that the price is not really reflective on the profit on this particular trade. If I go back in and I look at my log that I captured for this is the November 30th trade. I have let me pull that November 30th trade in. So I import my trades and I go back into my recorded trades that I keep. And let's see if I can find them. Here they are. Inside here. And this one is this trade, right? 6293 November. Let's say November 30th. November 30th. November 30th. Okay, so let me open that. And let's get rid of this. Get rid of that. All right, so I'm going to hide my current positions. So these are this was the initial trade that I made on Butterfly. So it looked like, in fact, let me do this too here. November 30th. I'm going to change this to November 30th. And I'm going to change this to set my lines at 1 sigma. Okay, so when I open this Butterfly, price was probably down here somewhere, or actually right around here, and it's gone up this far. So it's gone up a long ways. I only paid $190 for this, so it wasn't a very expensive Butterfly. The first thing I did is I actually did an iron condor on it, which looks like this. And really what that is I'm rolling my put down, my long put down, and I roll the bottom put up, and that allows me to collect some premium, but not to affect my margin. So I'll show you how that looks like on here. So here's the original trade. I have almost $4,000 of margin. I do this condor, which is rolling this put down and rolling this put up. Let me drag that over for you. Roll this put up. So here's what that condor, remember 4,000, almost 4,000. And so I still got almost $4,000, but I've rolled that top put down to collect $130. So originally it cost me $190. I've collected $130, so now the max I can lose is $60. If I put my cursor here, you can see in the bottom left, this part right here, it'll show you that it's minus $60 is the max I can lose on the right side of this Butterfly. Okay, so another opportunity came up and I did another roll, and I rolled this one for $180. So that raised my profit line up over here some more. Now my the minimum that I'll make the maximum I'll make at expiration is going to be, again, this cyan number down here for the 12-1 is going to be $120. So you can see right now that today I'm at a $30 profit on this trade, and I still have almost the entire month to go before expiration to realize the full profit on it. So another $90 of profit. But what I see on here is I still got a positive. This is a short put spread, and this is the long put spread. And the long put spread actually gets less and less value unless the price moves back into it. Where the short put spread gets less and less price, but if the price moves into it, it costs more and more. So you want this one to go to zero. You don't want this one to go to zero because this is, you owe for this one. Sorry, you owe money for this one, and you paid money for this side. So if you can get rid of this side and take that money back, then you can just wait for this spread right here to turn to zero. This is just a short put spread is all it is on this side. So we're going to roll this up here. This is the 2510, and right here in the middle now it's 2490. So I'll show you how I do that. I'm going to go over here to my option chain. Whoops, I don't know what that did to what you can see, but I'm going to go back to my option chain. This is for my September 30th trade. So let's go back on September 30th, or I'm sorry, November 30th. And we can see that long spread right here. So this is a long on the 2510, and I'm short on the 2490. So what I'm doing is when I roll it, I'm just rolling this one closer and closer to this short spread. So let's say I want to sell this. This column is a buy. This column is a sell. So if I click on the sell, that will add it to the bottom of my my chart down here. Which, let's see if I can get you where you can see that. Okay, here's my cursor, so I can go back down here. So I still don't get it on here. Be patient. Okay, so there, I can get $5 for selling this one, but then I'll have a short put that's not covered. So I need to buy back another put. So let's say that I buy this put right here. See, if I put my cursor over, it says buy. In order to make that one trade, one order, I have to do control click. I do a control click on the buy, and that creates me a vertical trade, which is vertical is the same thing as a calendar, but using the same dates. So now I'm taking the 2510, I'm rolling it down to 2500, and I get $65 more for that. So now my profit curve on here, I can make $185 on this trade. If I decide, okay, well, let's go ahead and turn it into just a short put spread, instead of doing this, I'm going to go ahead and sell this one right here, this one, and I'm going to buy that one. So I'm basically closing the long put spread. And so we had the one we're selling is the 2510, and the one that we're going to be buying back is the 2490. So I'm going to change this to 2490. And now I can get $120 for it. My max potential profit on the close of this trade is $240. You'll notice that now I have a big short put spread right here that is using $7,500 of margin. We started off on the trade with less than $4,000, and now it's all the way up to $7,500. So the question that you got to ask yourself is this short put spread risky or dangerous? Now, how dangerous is it? My short put spread is at 2510. If I go back to 2510 on this chart right here, I'm sorry, the short put spread was at 2490. I'm sorry, the short put at 2490 right now is at a delta 10, and the delta 10 means that there's a 90% chance that it will not expire less than this point, or a 10% chance that it will expire up over here. So there is some risk in the trade. There's a 20% chance, usually double the probability of expiring in the money. So if it's 10% probability of expiring in the money, there's a 20% chance of it going in the money while the trade's still on. So 1 in 5 chance that could happen. But when it gets down to about 10, I'm starting to feel comfortable enough that I'll go ahead and I'll roll that down, and I'll live with that 90% probability, especially since we're typically always in a bull market. And I can make other adjustments if I have to, if that starts getting into trouble. But I like picking up the extra $1.20. It turns this trade that was a loser. If I didn't have this, if I didn't make these adjustments to this 20/40/60, yeah, I'd be down. Right now, I'd be down only $65, but could have been down $190. But this is real cheap. Some of these I've paid $5 for, and some of them I have 5 contracts on. So that's $2,500. So I've been trying to manage these trades out and turn them into profits so that I don't have to take losses for them. And it looks like I'm able to do that to all of them that I've done so far. So using this technique is a good way to do that. If you have the margin room, you don't have to do this condor to roll the bottom put up, but that's the way that you can recover some of that margin. Let's look at what that would be right now. If I were to roll that bottom put up, here's my bottom put down here. See, these are getting cheaper and cheaper all the time. I can roll it all the way up to $2. So taking out $1,500 of margin out of here just by going from 2015 to 2430, and it only cost me $25, $175 and $200, so $25 difference between those. And I've lowered, and I'll show you that right now. I got, let's say that I've only done this trade and that trade. I'm at almost $7,500, and if I wanted to roll that up, I would. And it actually started. It started at 2405, but I've already rolled it up to here, so it would even be cheaper down there. But okay, so let's say I sell this one because I have one of them there. I want to get rid of it. I want to sell it. So I click on the sell column, and if I want to, let's take off a couple $1,000 here and go 1, 2, 3, 4. So I'm going up here. This is going to cost me $35, and I'm buying that. And you can see the $35 now on this vertical that I'm doing, and I've lowered it from $7,500 down to $5,500. So that's not very expensive to reduce the margin on a trade to do that, but it gets cheaper to reduce the margin the later into the trade you go. And so anytime you're making new highs on the chart, which SPX, it's not SPX. SPX has been this new high again today. Let's go back here, 6 month. You know, we're right there at that new high. That's a kind of a good time to take off margin. These type of pullbacks, when it has these type of days like this, those are the ideal days for rolling the upper put down, this put down, because this put then becomes worth a lot more when the chart pulls back like this. When it comes way down there and pulls back, you'll be able to sell those for more, and you'll be able to pick up more premium. So you can kind of optimize your trading by looking at how the price is doing relative to where it's been. So, you know, here's a good time to roll down, another time to roll down. The price is about right here. Time to roll up maybe at these tops. And when the volatility is really low, volatility right now, the IV percentage is 4.2, so 95% of the volatilities have been higher than this. So you know that it's a lot less expensive to roll that bottom one up when that volatility is that cheap. Anyway, so I hope that makes sense and helps you to be more profitable.